I like to record when I've been doing a Zoom, so just in case somebody has a technical problem, they might be able to watch it later because I'll post the video. All right, so let me do some sharing here. Go back to the 1041. Schedule D. I'm going to change that. Hold on a second. Change this. Change this. Back to here, 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 here. Share. All right. So you see the 1041. Let me get a little bit bigger. Okay. All right. So we talked about the 1041 and we made it all the way through the first page. So let's go to the second page. And I think we did talk about charitable deductions a bit as to how they work. That the only way that you get a charitable deduction is if the controlling document, whether it's a will or a trust, gives the money directly from the estate or trust to the charity. If it goes to the beneficiaries first and then the beneficiaries make a donation, the deduction does not belong to the trust or estate. It belongs to the individual beneficiary. As I said, I think on Tuesday, that what happens is, you'll inherit all of your grandmother's clothes, and you don't want your grandmother's clothes, so you donate them to the Salvation Army, and they give you a receipt for having donated the clothes. Well, that receipt is yours because you inherited the clothes. That deduction does not belong to the estate because grandma didn't leave the clothes to the Salvation Army; she left them to you. So you end up with the deduction, not the trust or estate. All right, that being said, let's move on to Schedule B, because this is really the most important part of page 2. The income distribution deduction. So as I was telling you the other day, that this can either be a pass-through entity or a tax-paying entity, depending on a whole lot of circumstances. And if it is a pass-through entity, then what happens is we've distributed the income from the trust or estate to one or more of the beneficiaries. And by doing that distribution of income, we actually get a deduction for that. We saw on the first page that we do have on line, whatever it was, a deduction for distributions to beneficiaries. And that is calculated here on Schedule B. All right, so Schedule B, let's just take a look at what the lines are all about. Line 1 is adjusted total income, see instructions. That's going to come from the first page. Okay, that's going to be well, I should be able to get to it pretty quickly here. That's going to be realistically line 23. No, that's not right. That's realistically going to be adjusted total income, line 17. Okay, so it's line 17. Line 18 is the income distribution deduction from Schedule B. So going back to Schedule B, right? Total adjusted income, that's line 17 from page 1. Adjusted tax exempt income. All right. One of the things that's going to happen is if we're not required to list the income because it's non-taxable. Okay, so we have some municipal bond interest here. So it's going to be non-taxable interest. We're not going to show it on page 1 because we only report taxable stuff on page 1. In Schedule B, what we're doing is calculating the amount of the deduction that we're going to be allowed. Now, if part of what we're actually paying out to the beneficiary is tax exempt income, we're not going to get a deduction for it. And that makes perfect sense because we're not showing it on page 1, so we're not going to pay tax on the tax-free interest. If we end up distributing the tax-free interest to the beneficiary, we shouldn't get a deduction. So we shouldn't get a deduction against taxable income for distributing non-taxable income. Okay, so line 1 is all of the taxable income that we saw on the first page. Line 2, we now have to disclose the tax exempt interest that we had. And what's going to happen, we're going to end up adding those numbers together. So if we had $10,000 worth of taxable income on line 17, and then we end up with $1,000 worth of non-taxable interest, we're going to end up having $11,000 worth of income that we have to worry about distributing. Okay, so keep that in mind as we move forward. Line 3, total net gain from Schedule D of Form 1041, line 19, column 1, see instructions. We're going to look at the Schedule D also. It's a unique form to this, the Schedule D is unique to the 1041. So, okay, that's fine. Line 4 is enter amount from Schedule A, line 4, minus any allocable Section 1202 deductions. Line 4 is capital gains allocated to corpus. So it was something we did, it was a capital gain that we didn't get a tax deduction for. Realistically, I'm never going to give you anything like that. It's also a relatively rare thing to see in the real world. But we're not going to really have anything on that line 4 in this class, at least. Line 5, capital gains for the tax year included on Schedule A, line 1. Once again, unless we have some sort of a strange trust that's existing for the purpose of creating money for charities, we're not going to have anything there. Schedule A, anytime they reference Schedule A above, that's that charitable stuff. Okay, so if we're not going to be doing anything with that, don't worry about those numbers. Line 6, enter any gain from page 1, line 4 as a negative number. If page 1, line 4 is a loss, enter the loss as a positive number. Okay, so looking at page 1, line 4, that's capital gain or loss from the Schedule D. All right, so what it's asking you to do is to change the sign. If it's a positive number, it wants you to treat it like a negative number. If it's a negative number, it wants you to treat it like a positive number. Because if you look at the next line, line 7 is distributable net income. We in the business call that DNI. Combine lines 1 through 6. If 0 or less, enter 0. So what we're doing here is we are accumulating all of the income to get to line 7. All right. So whatever the first, whatever line 17 is for taxable income after the deductions that we were allowed, then we add in tax exempt interest because that's income, although it's not being reported for tax purposes, it is income for the purposes of this calculation. And then we talk about the capital gain or loss, ignoring the stuff that would have been on Schedule A for charities, because we're not going to be dealing with that. If we had a capital gain on the first page, that would have been on what, line 4? If let's say that we had a $5,000 capital gain on page 1. I had told you that we, for purposes of trust and estate accounting, we are concerned not with debits and credits, but income and principal. Okay, income is such things as interest and dividends. And I guess also if we end up running a business because we have a decedent's business that we're running, could be, a business income. But capital income, capital gains, they are part of principal. They're not part of income. Now the IRS says, okay, this is all income, so we have to worry about taxing it. Yeah, okay, if we had a recognizable event, so we have to recognize capital gain income, then it's going to be listed as income on page 1 because it is taxable income, but it is not distributable income. We do not distribute the capital gains because they belong to the principal of the trust or estate. And so therefore, we will not be distributing it. That will be allowed to roll over and increase the value of the trust. All right. Since it's not distributable, we have to remove it from the number that we're calculating here, which is distributable net income. So if I have $10,000 in interest or whatnot above, and then I have $5,000 worth of capital gains, let's say that my line 17 says $15,000. On line 1 of the Schedule B, I'm going to have that $15,000 because it's basically line 17. But we know that that $5,000 of capital gain is not distributable. So therefore, line 6 says enter any gain from page 1, line 4 as a negative number. We then make a negative $5,000 entry here on line 6, which then says, oh, okay, when we do the combination of all of the numbers here, the $15,000 was overstated by the $5,000 of capital gain income, which we're not going to distribute. So it's going to be the 15,000 minus the 5,000. That'll give us the $10,000, which according to trust law, according to the document, is not going to be, has to be distributed, or at least is available to be distributed. Okay. So conversely, if we had a capital loss on page 1, now we're going to be using the interesting thing is that the fiduciary income tax return, form 1041, it uses mostly the individual tax rules. Okay, so when we did the corporation, the C corp, capital losses were not deductible; they were allowed to be carried over. When we did the pass-through entities of the 1120S and the 1065, we did capital gains and losses on Schedule K, and they ended up being distributed back to the individuals. Since this is a taxpayer, and we know that if we're holding the capital gain in the trust, then the trust is going to end up paying the tax because somebody has to pay the tax. The IRS doesn't care about any of these trust rules, other than they will allow us to choose the entity that pays the tax. Okay. If the trust is going to pay the tax, that's fine. The IRS is happy. Somebody's paying the tax, but we're going to be using the individual rules. Okay. So now, if you remember back to, or if you studied the personal taxes, you'll see that if you have a significant capital loss, it's going to be capped at $3,000, right? For individuals. Same rule applies here on the 1041. So if we have that $5,000 loss, page 1 is only going to say 3,000 because, and you'll see when we get to the Schedule D, we're going to be limited to a $3,000 loss because it's the individual rules. So page 1 will say $10,000 of interest and dividends or whatever, a negative $3,000 because we have this capital loss capping at $3,000. So line 17 would have been 10,000 minus 3,000, 7,000. Okay. Schedule B would be line 1 would be $7,000. But then when we get to line 6, it says if line 4 is a loss, enter it here as a positive number. So we would add back in that capital loss to bring us back to the $10,000, which is the income under the income and principal rules. So it would be the income that's available for distribution. Okay. So that's why line 7 gets affected the way that it does. So always be careful what sign you give to any number on line 6. If it's a capital gain on page 1, it'll be a negative number here. If it's a capital loss on page 1, it'll be a positive number here. Okay. Line 8. If a complex trust, enter accounting income for the tax year as determined under the governing instrument and applicable local law. All right, I have to go back to page 1 because it's time to start scaring you with different types of trusts. All right, so at the beginning of Form 1041, I showed you that there are on the, I'm going to use the cursor up over here, we have a multitude of different types of entities that use this form. And the first one is decedent's estate. The second one is simple trust. The third one is complex trust. And then if you skip down a couple more, you're going to get to grantor type trust. Okay. So now we have to discuss what different trusts are. Okay. The difference between a simple trust and a complex trust is that the document that creates the simple trust requires that all income be distributed at least annually to the beneficiary. So there's no discretion on the part of the trustee as to whether to distribute income or not. It is required to be distributed. Now, if you remember back to Tuesday when I was talking about the fact that if I'm designing the trust, I'd much rather have the trust distribute the income, because having it taxed at the individual's rate as opposed to at the trust rate, if I accumulate the income into the trust, we're going to pay tax in those highly compressed brackets. So we're going to pay a lot more tax if we pay the tax in the trust. I always want to write the trust document to require the distribution of income. Okay, so if I'm successful and the client says, oh, yeah, we should probably require that the income be distributed so that we pay the least amount of tax, I write the document to require the distribution of income on an annual basis. That's a simple trust. Okay, the definition of a simple trust is it's a trust that requires the distribution of income on at least an annual basis. Okay, so all of the income is required to be distributed. A complex trust. A complex trust is a trust that does not require the distribution of income. What will happen is the trustee will have discretion that they can distribute income if they want, either because there's some standard that they are being met, having to meet. The beneficiary asks for money to pay for education. We give them money for tuition. Well, that's a distribution. It's going to be a distribution of income, but it wasn't required. If the beneficiary did not ask for that money, the trustee would not have distributed it, and it would have retained it. It would have been retained in the trust. Okay, so a complex trust is a trust that may or may not distribute income. All right. A grantor type trust is something that we play with purely for tax purposes. We create a trust, and the easiest type of grantor trust that we can get really sophisticated, where we create a trust that looks like it's a complex trust, but we purposely draft a flaw into it to make it a grantor trust. But what a grantor trust is a trust that remember when I talked about completing the gift? In order for a gift to be complete, I have to give up complete dominion and control, and I have to intend that the gift be made. Okay. If there's some flaw in the way that the gift was made, and when you create a trust, what you're really doing is you're giving a gift. Whoever the beneficiary is getting a gift from you. Okay. Now, what I can do is I can create a trust where I purposely screw up the completed gift. All right. And the most common one is what we refer to as a grantor type trust, where I don't give up complete dominion and control over the assets. I name a trustee, I give them my assets, but I retain the right to revoke the trust or to ask for my assets back. Okay. A completed gift means, here, trustee, here's all my stuff. I have not reserved the right to revoke the trust. Therefore, it would either be a simple or a complex trust. Here, trustee, here's all of my assets. Invest them as you will, and then give me the income whenever it's created. And oh, by the way, I'm retaining the right to revoke this trust, fire you, and get my money back. If I do that, I've screwed up the completed gift. By doing that, I've created a grantor trust. Not a simple trust, not a complex trust, a grantor trust, because I still have too much control over the assets. Okay. A grantor trust is an absolute pass-through entity. Everything is, for tax purposes, is considered to still be the property of the person who created the trust, the grantor of the trust. So for tax purposes, I'll be very honest with you, we generally don't even bother getting a new employer identification number for the trust. We just use the social security number of the grantor. And then everything gets reported under his social security number. A lot of times when we file this trust, we put the name and address and everything of the trust at the top. And then we just write across it grantor type trust and we turn it in empty. Now we may end up putting a schedule on the back that shows the income created by the trust so that it corresponds with the money that the grantor got from the trust, from the investments. But for tax purposes, everything, including capital gains and losses, belongs to the grantor because they never gave up control of the assets. We're not going to do grantor type trusts, okay? They're common out there, but the taxability of them is very simple. We generally don't worry about it. If you didn't file the return for a grantor type trust, there's not a lot of problem with that because there's really no tax effect to a grantor trust anyhow. Why do they exist? Well, because we wanted to move the assets out of the name of the owner. I had a client once who came to me and he said, I want to do a grantor trust. Now, sir, first off, I don't like grantor trusts. I don't generally write them for my clients because in Pennsylvania, they serve no purpose. I'll explain that in a minute. But he came in and he said, I want to do a grantor trust. And I said, well, give me your reason why. And he said, in my family, nobody has ever made it past age 64 without becoming severely senile. So I'm convinced that at age 64, I will be completely senile. And what I want to do is I want to create a trust where my daughter will be the be the trustee, and therefore she'll have control of my assets. And when I become completely senile, it will be seamless. She'll already be in charge of everything. So I made him the trust. Guess what happened? He turned 64 and went completely senile. He saw the future. It was a good use of the trust because now all the assets are already in the name of the trust. We have a trustee who's already in charge of all of the assets. We didn't have to do anything to change his financial life. Now, another reason that we would use a grantor type trust is because if you live in certain states.
Wait, I have a question.
Yeah, go ahead.
So if assets,
You broke up there. Give me an ask again.
when he dies, does she take control of the assets?
She already has control of the assets, and in the trust there will be a clause that tells her how to distribute the income, or excuse me, how to distribute the assets after his death. Now, in that particular circumstance, she was the sole beneficiary. So after he died, she just took over ownership personally. So it became also a will substitute. We didn't have to have a will.
I was going to say, does that count as a trust, or does that go to?
It would still be a trust. The only thing that would happen is upon his death, it takes time to actually stop, to collapse a trust. So it's about 6 months to actually get everything closed off in a trust. So in the period of time after he died and before she terminated the trust, it converted from a grantor trust to a simple trust.
And so now on the final, like the final return, would it be a simple trust then? Like
yes.
The box they would check?
Yep. That's exactly what we would do. All right. So in other places, okay, for probate purposes, if you die in Pennsylvania, we probate your will and we have an executor appointed by the court system, okay? And that's called the probate process. And anytime, I'll just tell you guys this, anytime you go to the courthouse, make sure you take your checkbook because you're probably going to have to pay some sort of fee. There's a fee to probate your estate. And in Pennsylvania, the fee to probate your estate is based on on your wealth. So there's a schedule that from 0 through $75,000 in assets, it's this price. From $75,000 to $250,000, it's this price. From $250,000 to $1 million, it's this price. So if you had an estate worth about $500,000, your probate fee in Pennsylvania would be $400. Okay, not free, but not a huge number. If you lived in Florida, Florida doesn't have an inheritance tax, but they do have probate fees. In Florida, if you died with an estate of $500,000, your probate fee would be $50,000. See, they don't charge an inheritance tax, they get you on the fees. So, hey, here's the deal. If you're a resident of Florida, open up one of these grantor trusts. Ownership of everything has been transferred over to the trust, and it's a will substitute. When you die, it tells us where to distribute everything when you're gone. But hey, here's the problem for Florida, at least. When you die, what did you own? Nothing. The trust is a separate entity, and it owned everything. What's your probate fee? 0. Once again, where are you, Austin? Planning. I can save them $50,000 by creating this trust.
Ooh.
So that's why you get the big bucks. All right. So we're not going to worry about a grantor type trust because for our tax purposes, it doesn't really apply. All right. So we're going to be dealing with 3 entities then, either a decedent's estate, a simple trust, or a complex trust. Okay. It makes a difference in a couple of places. One of those places is Schedule B. Okay. So now line 8, if a complex trust enter accounting income for the tax year as determined under the governing instrument and applicable local law. So if we had a complex trust, we would have to report the accounting income of the trust on line 8. If we're not a complex trust, we can skip line 8. If we're not a complex trust, we're either an estate or a simple trust. Okay. If we're a simple trust, let's go to line 9. Income required to be distributed currently. Well, what's the income that's required to be distributed currently? All of the income, right? Because of the terms of being a simple trust, you have to distribute all income that's created by the trust. So line 9 would be all of the income, tax-free and taxable income on line 9. Line 10, other amounts paid, credited, or otherwise required to be distributed. All right, so if we're a complex trust, we use line 10 to show the amount that we actually did distribute. Okay, so simple trust, line 9 is all of the accounting income. Line 10 is for a complex trust, and it's the physical amount that was actually distributed. All right, line 11, total distributions, add lines 9 and 10. So if we add lines 9 and 10, well, we're only going to have a number on one of those lines probably. So it's going to be carry line 9 down or carry line 10 down, depending on whether we're a simple trust or a complex trust. So line 10, we're going to have the amount of money that we distributed, either the full amount of income because we're a simple trust, or the physical amount that we distributed because we're a complex trust. Line 11, or excuse me, 12, enter the amount of tax-exempt income included in line 11. All right, so if we had tax-exempt income as reported on line 2 above, see, adjusted tax-exempt interest, we would then bring that number down. It's almost always going to be that same number from line 2. Okay, so now what's happening is when we get to line 11, we're showing all of the money that's been distributed, all of the income and all of the money that's been distributed. But the whole purpose of Schedule B is not to calculate out how much money we distributed. It's to calculate out what is our deduction for that distribution. Okay, so line 2 above threw the tax-free income into the bucket. And now line 12 is pulling it back out. Now, the reason that they do that is if this is a complex trust, we may not have distributed all of the tax-free income. Because see, if we didn't distribute all of the income, that means we're leaving some income behind in the trust. And we don't get to choose whether we distributed tax-free income or taxable income. The IRS is going to make us allocate it. So if we had 50% of our income was tax-free income and 50% of our income was taxable income, whatever our distribution, our physical distribution in that complex trust would be, only half of it would have been the taxable income. So half of it would have been the tax-free income. So then line 12 there would be enter the amount of tax-exempt income on line 11. So whatever amount of tax-free ended up being allocated into the actual distribution, we have to remove it out, because all that's going to be left then on line 12 is going to be the taxable income that we distributed. Okay, so line 12 says enter the amount of tax, excuse me, line 13, tentative income income distribution deduction, subtract 12 from 11. Line 14, tentative income distribution deduction, subtract 2 from line 7. It's 0 or less, enter 0. So 2 from line 7. Line 2 is adjusted tax exempt interest. Line 7 was distributable net income. If we ended up with 0 or less because we had more tax exempt income than the amount that we distributed, then we're going to end up with no distribution. Line 14, tentative income distribution, subtract right here. Line 15, income tax distribution, the smaller of line 13 or 14. So we're going to end up with the amount of taxable income that gets distributed, because it's going to be the smaller of 13 or 14. That gets entered on line 15, and then it goes back to line 18 on page 1, our income distribution deduction from Schedule B, line 15. Okay, so it's a lot of work to get that number. It appears to be a lot of work. In a simple trust, it's really not a lot of work. I'll show you how that works when we start throwing numbers into the forms here. All right, sliding down, continuing on page 1 here. Line 19, estate tax deduction, including certain generation skipping taxes, a tax computation. If we are in the first year of an estate and we end up paying estate tax, okay, that's the death tax, it's a federal death tax, we get a deduction for it here. So it should, theoretically, that's such a large number, it should wipe out our income here. But we do get a deduction if we pay estate tax during this particular tax year. I'm not going to give you any kind of problems that will require that. So for our purposes, you can ignore it. Understand that that is a possible deduction if you're very early in a very big estate that has an estate tax problem. Line 20, qualified business income deduction. So if you have, remember in the tax revision, you get a deduction for certain types of businesses. That can happen here. If we're running a business, we could end up with a deduction here. I'm not going to have that be part of any of the things we do, because 99% of the trusts and estates we're dealing with not businesses, but you're dealing with passive type of income. Line 21, exemption. All right, just like on your individual income tax return, you get an exemption for each person that's listed on the return. So if you're single, you get 1 exemption. If you're married, filing jointly, you get 2. If you have children, you may get more exemptions. We don't care about how many children you have or anything here. The exemption is going to be driven by what entity you are. All right. If you are an estate, the exemption here is $600. If you are a simple trust, the exemption here is $300. If you are a complex trust, the exemption on line 21 is $100. Okay, so I told you the entities we're going to be dealing with are estate, simple trust, and complex trust. So those are the 3 numbers that you need to remember for line 21. An estate is 600. If you are a simple trust, 300. If you're a complex trust, 100. Line 21, add lines 18 through 21. So that's the income tax, income distribution deduction that we calculated, and these other things which aren't necessarily going to apply, plus your exemption. That's line 22. Line 23, subtract 22 from 17. So it's going to be 22, which is our total deductions, which is the income distribution deduction plus your exemption, subtracted from your taxable income above. That goes on line 23. Now, I'm going to tell you right now that you should be able to recognize some patterns when you start doing these things. As I said, I've done tens of thousands of these, so I know what the pattern is going to look like. If it's a simple trust, requires the distribution of all income, the taxable income on line 23 is going to be a negative $300. Why? Because no matter what our income is above, if we don't have a capital gain, that is, no matter what our income is above, it's all going to be distributed. We're going to get the deduction for all of the income. So let's say that it's $10,000 in income. Our income distribution deduction is going to be $10,000. We're going to have that $300 exclusion. So it's going to be 10,000 minus 10,300, negative 300. Okay. So a simple trust with no capital gain, line 23 is always going to be negative 300. If it's a complex trust where you distribute all of the income and there's no capital gain, line 23 will always be a negative $100. If it's an estate where you have income and distribute all of the income and there's no capital gain, line 23 is going to be a negative 600. Okay, so basically that exclusion doesn't do you any benefit unless, when are you going to pay tax on this form? When you have capital gains. Okay, so think about it. We have the income that we're getting from interest and dividends. If we add in whatever our capital gain is, that's what's going to give us our total taxable income. Then we're going to have our expenses that are going to be above line 17 there. So line 17 is going to be our taxable income. We're going to distribute everything. Oh, wait a minute. When we calculated our distribution deduction for line 18, we had to add back in or subtract out. Well, yeah, we had a capital gain, so we had to subtract out the capital gain. So therefore, our income distribution deduction is going to be whatever our taxable income is, less the capital gain, because we can't distribute the capital gain. So that means when we subtract line 22 from line 17, what's going to be left over is going to be the capital gain minus the exemption. So go back to the number that I threw in there before. If I have a $5,000 capital gain, no matter what my income is, my deduction is going to be the income on line 17 less the amount of the capital gain. So what's going to net out for line 23 is going to be the capital gain, which I can't distribute, minus the exemption. So if I have a $5,000 capital gain and it's a simple trust, my taxable income is going to be $4,700. If I have a capital gain and it's a complex trust and I distribute all income, line 23 is going to be is going to be $4,900. If it's an estate and I distribute all income and I have a $5,000 capital gain, line 23 is going to be 5,000 minus 600, 4,400. I know that because I've done this a million times. Okay, so I can look at your form and I can tell you what the numbers are going to be just because I've done so damn many of these. Moving down, starting with line 23, we get to taxes and payments. Line 23, taxable income, so that's 22 from 17, okay. Line 24, total tax from Schedule G, Part 1, line 9. Well, that's right here. That's on page 2. Here's line 9, right here. Okay, so tax, line 1, A, tax on taxable income. See instructions. Tax on lump sum distributions, the tab 4972. We're not going to be doing that. C, alternative minimum tax from Schedule I. We're not going to be doing alternative minimum tax. So 1D is going to always, in our purpose, is going to be the same as tax on 1A, tax on taxable income. I guess I'm going to stop sharing for just a minute because I want to, can't do that. I want to bring up the instructions for Form 1041, and we'll take a look at those real quick. Because I want to talk about how you calculate the tax. And once again, you're only going to have the tax if you give me a second, I'll make sure I'm getting the right thing here. Yeah. You're only going to have tax if you have a capital gain, right? Okay, let me go back. All right, let me share my screen. All right, you should be seeing the instructions for Form 1041. Schedule G is where we were at. So Schedule G, computations and payments, is line 30 or page 30. So, all right, Schedule G, tax payments, tax computation and payments. All right. For tax years beginning in 2021, figure the tax using the following tax rate schedule and enter the tax on line 1A. However, see the instructions for Schedule D, Form 1041, and the qualified dividends tax worksheet later. Okay, so this is that tax rate schedule that we had talked about on Tuesday. Once again, looking and seeing that at $13,500 of income, you're already at the maximum marginal tax rate of 37%. So we don't like that. That's a nasty tax rate. So that's why we like to have the ability to distribute income whenever we have the chance to. So understand that's the way we do that. Okay, continuing. Schedule D and Schedule D tax worksheet. Use Part 5 of Schedule D or Schedule D tax worksheet, whichever is applicable, to figure the estate or trust tax if the estate or trust files Schedule D and has a net capital gain and any taxable income or qualified dividends on line 2B2 of Form 1041 and any taxable income. All right. I don't need to share this anymore. What we have here now is information that tells us that we can calculate our tax in two different places. We can either calculate the tax using that tax rate schedule that was right at the beginning of that section of the 1041 instructions, or we can calculate our tax on Schedule D. So let me go to Schedule D now. Let's see. Schedule D, share, Schedule D, share. All right, so you're looking at the Schedule D, capital gains and losses, once again, specified for Form 1041. Name of the state and trust, employer identification number. All right. Did you dispose of any investments in qualified opportunity funds? We're not going to be doing that because that's a specialty tax type thing. Part 1, short-term capital gains and losses. We have the ability to not report in the individual transactions if everything was reported to us on a 1099-B and there is basis reported to the IRS and we're not going to have any adjustments. Then we can just do the totals. Otherwise, we have to use 1B, 2, or 3, where we checks box A, box B, or box C. all the other things we've seen before. Short-term capital gain or loss from another form, gain or loss from partnership, S corps or other estates or trusts, short-term capital loss carryover. For estate and trust purposes, we maintain the difference between short-term and long-term losses. So if we have a short-term carryover, we maintain its status as a short-term loss. We're carrying it forward. That would appear on line 6. And then line 7 is summarizing everything. Same thing for the long term. When we down in part 2, we don't have to put out the details. We can use line A, or we can use line 8B, 9, or 10, depending on if we're checking box D, E, or F. Long-term loss from those other forms, long-term gain or loss from partnerships, S corps, or other trusts or estates. Line 13, capital gain distributions. We talked about that. 14, gain from form 4797. We know what that's all about. Long-term capital loss carryover. So if we had a long-term loss carried forward, they would be here on line 15. Line 16 would be combining all of that. Let's go to page 2 where the fun starts. Summary of parts 1 and 2. Short-term gain or loss, line 17. We have line 1, column 1, beneficiary, column 2, estate or trust, column 3 is total. So if we had a short-term gain or loss, we would put that on line 17. All right, so let's assume we have a $5,000 capital gain, short-term. Well, I'll tell you right now, it's going to end up on line 17, column 3 for starters. Okay, so we'll put the $5,000 in this box right here. I'll put it in. Okay, now we have to do it in either column 1 or column 2. If the gain is going to be distributed to the beneficiaries, we put it in column 1 right here. If the gain is going to be maintained in the trust, it would go here. So for most of the time, our purposes, we're going to be putting that gain or loss in column 2 and column 3. Okay? Column 1, well, wait a minute, Kamalchak, you told us that it's always going to end up being captured in the trust or estate because it's not income, so we don't distribute it to the beneficiary. True. But can I write the trust so that it distributes not only what we would consider to be trust income, dividends, interest? Can I write the trust to say that the trust should also distribute the capital gains that are created or capital losses to the beneficiaries? I could. Okay. I don't want to. I generally don't. That's not the purpose of the estate or trust. The purpose of the estate or trust is to hold, maintain, safeguard those assets, allow them to grow until we make final distribution. So it's going to be rare that we're going to use column 1. Yeah, it's there. And yes, we can use it on occasion, but it's not the normal place you're going to see the number. Okay. Anything I'm going to give you is going to be in column 2 and then in column 3 because we have to have the total there. Okay. Now, another time you're going to use column 1 is in the final year of a trust or the final year of an estate. You have to distribute everything. All right. You can't say to the IRS, all right, the estate is done, it doesn't exist anymore, or the trust is done, it doesn't exist anymore, and still have money. It has to be completely gone. I have to distribute everything either to the beneficiaries of the estate or to the beneficiaries of the trust. Then the trust is terminated. In that year, yeah, I'm going to use column 1 because I'm not maintaining any of those gains or losses inside the trust anymore. Once again, it's there, it is used, it's not, completely unusable. But for our purposes, we're going to be talking about ongoing trusts and ongoing estates. Column 2 is where we're going to be. Okay. All right. Net long-term gain or loss total for the year, line 18. So we're going to have our long-term loss, gain or loss. Once again, we're probably going to end up at column 2 and column 3. Okay. unrecaptured section 1250 gain. So a 1250 gain would have been something that came from the 4797. We're not going to have that because I'm not going to give it to you. Something that has to be taxed at 28%. That's like collectibles have to be taxed at 28%, regardless of whether it's long-term or short-term. I'm not going to be giving you that. Total net gain or loss. We're going to total everything. So for purposes of this illustration, we're going to have $15,000 of gain or loss. Gain. All right. If we had a loss, we would go to part 4, capital loss limitation. Enter here and enter as a loss on form 1041, line 4, or schedule A 990T. 990s for charity, by the way. Part 1, line 4C, if a trust, the smaller of the loss on line 19, column 3, it's up here, or $3,000. Okay, so if I had a $5,000 loss, right here, it tells me that my limit that I'm allowed to deduct is $3,000. Note if the loss in column 3 is more than 3,000 or form 1041 is a loss, complete the capital loss carryover worksheet in the instructions to figure your capital loss carry forward. Okay, so if I'm going to have a capital loss, I'm going to be able to carry it forward. I'm only allowed to deduct $3,000. You want me to make your life a little bit more complicated? Let's say we had a loss here. Let's say that the loss was $10,000 and we're only allowed to deduct $3,000, right? So we're going to put $3,000 here on line 20, and we're going to carry that $3,000 to page 1, line 4, right? As a negative $3,000 capital loss. What's your carry forward? Anybody want to take a shot at that? What's your capital loss carry forward under those circumstances? Abraham, what do you think?
Would it be the difference?
You would think, right? Logically, you're thinking, okay, I have a $10,000 loss, but I'm allowed to take $3,000 on page 1 of this form. So I should only be allowed to carry forward 7. That makes perfect sense. But once again, this is the tax code, and we're talking about something even stranger, a trust or an estate. No, your carry forward would be 10,000 because you didn't get to use any of that 3,000, did you? Did the 3,000 actually affect your tax? It's a simple trust. All of the income gets distributed. So you don't have any income for this $3,000 to be used up against. So you got no benefit from this $3,000. The IRS is generous here. They say, if you don't use that against income, then you get to use it in your carry forward. So it's strange. It would appear that you should only have a $7,000 carry forward, but you will indeed have the full 10,000. Unless it's a complex trust, and yes, you do get to use it against some of your income, then you'd have to use the worksheet and show that you use it against this much income, so only a portion of it gets carried forward. Strange. All right, moving on to part 4. Oops, lost the page. There we go. Part 4. Tax computation using maximum capital gains rates. I'm not going to do the numbers here. I just at the beginning, I just want to go through so you can see what this is all about. The whole purpose of part 5 is to compute your tax using the maximum capital gains tax rate. As I said on Tuesday, capital gains income is a preferential type of income. So you pay a lower tax rate on capital gains than you do on ordinary income. Did I say lower rate? If I said anything different, I meant you pay a lower tax rate on capital gain income than you do on ordinary income. Okay. I think it's capped at 20%. You do see that if we had a large enough number, and this is a trust, we could easily be in the 37% marginal tax bracket. So we would want to use part 5 to calculate our tax rather than have it taxed as ordinary income. So line 21 is enter taxable income from line 1041, line 23. So that's going to be that that number that's after we end up deducting the distributable net income and the exclusion. So basically, it's going to be our capital gain minus our exclusion. Line 22, enter the smaller of line 18A or 19 in column 2, but not less than 0. 18A or 19. So this is going to be the smaller. Because line 19 includes the short-term gain, you don't get a break for short-term gains. You only get a break for long-term gains. So they want to know if our long-term gain is smaller than our total gain, which it is in the example I'm giving here. So $10,000 is smaller than 15,000. So on line 22, we would end up putting the 10,000 because it's smaller. That's the cap. That's the long term. All right. So let's assume that this was that this is a simple trust. What would line 23 on the first page be? Well, it would be the 15,000 minus 300, so it would be 14,700. So let's just do this. Enter the estate or trust qualified dividends from 1041, line 20, 2B2, or enter qualified dividends. Now, qualified dividends. I know we talked about this a little bit, but let's talk about it again. When you get dividends, there are two different types of dividends that can be reported to you. Just ordinary dividends or qualified dividends. Ordinary dividends are all of the dividends you've received. Inside of those ordinary dividends can be qualified dividends. And qualified dividends, the easiest way to describe that is it's dividends that are paid by a US-based company. Because the government is feeling, okay, we're going to get the income tax from that company, we'll give you a little bit of a break on the dividends that you receive from that US-based company. So ordinary dividends are all dividends. Some portion of that is going to be qualified dividends. You get a tax break. You get to treat qualified dividends the same way that you treat long-term capital gains. Okay. For our purposes here, I'm going to assume that that's 0, but in later examples, we'll have that be a number. Okay, so add lines 22 and 23. So line 24 is going to be that $10,000. We're not filing a 4952. So we're not going to be giving a number, so we'll have a 0 here. Line 26, subtract 25 from 24, so that's still going to be the $10,000. Line 27, subtract 26 from 21. If 0 or less, enter 0. All right, subtract 25 from 24, excuse me. Yeah, 25 from 24. I'm sorry, that's for line 26. All right. Line 27, subtract 26 from 21. So 14,700 minus 10,000 is going to be $4,700. Line 28, enter the smaller of the amount on line 21 or $2,700. Okay, so 21 is 14,000. 2,700 is smaller, so $2,700. Enter the smaller of the amount on line 27 or line 28. So 27 is 4,700. Line 28 is 2,700. So smaller is $2,700. Line 30, subtract 29 from 28. 0. Line 31, enter the smaller of line 21 or 26. All right, 21 is 14,700. 26 is 10,000. So still 10,000 is a smaller number. 32, subtract 30 from 26. So 26 is 10,000. 30 is 0. 32 is going to be 10,000. 33, enter the smaller of line 21 or $13,250. 21 is that 14,7. So that's the smaller is 13,250. Line 34, add 27 and 30. Okay, so 30 is 0. 27 is 4,700. So 4,700. Line 35, subtract 34 from 33. 4,700 from 13,250. I don't have a calculator. 9, 8,500. Is that no 8,550? No, 8,750. Who's got a calculator? $50, 12, 5, 12. Okay, 8,750. 36, enter the smaller of 32 or 35. 35 is the smaller, 8,750. Line 37, multiply 36 times 15%. So, let's see if I can bring up my calculator on my computer here. All right, so 8,758. 750 times 0.15 equals, that's not right. Try it again. 8,750 times 0.15 equals 1,312.50. There is a purpose to what we're doing. Doesn't look like it, but there is. Enter the amount from line 31. All right, 31 is 10,000. 39, add lines 30 and 36. 30 is 0. 36 is 8750. So it's going to be 8750. Line 40, subtract 39 from 38. This is going to be 1,250. Line 41, multiply line 40 by 20%. Okay. So 1,250 times 0.2, $250. Line 42, figure the tax on the amount on line 27. Use the 2021 tax rate schedule for estates and trusts. So 27, $4,700. I know that what it looks like we've been doing is just weird gyrations that don't make any sense whatsoever. But now I'm going to show you what we're trying to do here. That $4,700, if you go up far enough on the Schedule D, that is the short-term gain minus our exclusion, okay? Because the short-term gain is taxed as ordinary income. It doesn't get the preferential treatment. What we're doing on this form now is we're calculating the tax at the ordinary tax rate because we have to pay that tax on what's going to be taxed as ordinary income. So, I need a piece of paper now. Okay, so let's go back. We know that the number is 4,750, or 4,700, excuse me. So 4,700. Now we have to, unfortunately, I'm going to stop sharing. We have to go back to the instructions. And here are, I have to share again. Share instructions. Okay, so you should be seeing the instructions again. And as such, you see the tax rate schedule. So we have $4,700, which is going to be in this second bracket here. So it's going to be $265 plus 24% of everything over. Oh, wait a minute, I'm sorry. Down, actually, we're down here, 13,000, the top bracket. No, wait a minute. I was doing the 14,000. The 4,700 is in this bracket. I was exactly right. So 4,700 minus 2,650 is going to be 570, $2,050. So $2,050 times 24%, 2050 times 0.24 equals, somewhat wrong, 2050 times 0.2 equals, still not working. What am I doing wrong with my calculator here? 2050 times 0.24 equals 492. So 492 plus 265 equals $757 using the tax rate schedule. Okay, I'm gonna stop sharing again. Let's go back to the form. Schedule D. Screen, schedule D. All right, so line 43 says add, figure the tax, line 42, figure the tax on line 27, use the tax rate schedule. We calculated it out at $757. Okay, line 43, add lines 37, 41, and 42. So 37 is here, 41 is here, and 42 is here. So give me a second, get my calculator back up. 1312.5 plus 250 plus 757 equals 2,319.50. So let me put that on line 43 here. 2,319.5. Line 44. Figure the tax on line 21 using the tax rate schedule. Now, line 21 is the full amount of the income. So it's all of the income that we had, less the exclusion of $300. So now they're telling us to go back and calculate that the tax on that number, 14,700. All right, so let's go do that. I'll stop sharing. I'll change my screen to the instructions again. I'll share again. Okay, so 14,700 would be in this top bracket here, the 13,050 and above. So it's going to be 3,146 plus 37% of everything over the 13,050. So 13,050, excuse me, that's wrong. 14,700 minus 13,050 equals 1,650 times 0.37 equals 610.50 plus the 3,146 equals 3,000, writing this down, 756 and 50 cents. Okay, stop sharing. Back to the Schedule D. There's screen, Schedule D. All right, so line 44 will be 3,756.50. Line 45, tax on all taxable income. Enter the smaller of line 43 or 44 here and on Form 1041, Schedule G, Part 1. All right, so the smaller between line 44 and 43 is the $2,319.50. All right, now, what we've done here to try and explain the way that this form is working, we end up with paying tax at different rates on the capital gain. So on line 31, what they're doing is they're isolating the long-term capital gain that we're going to be paying tax on. So $10,000 of our income is long-term capital gain. So now we're going to pay tax on that. So the first $13,250 of our income is going to have preferential treatment. 4,700 of that's going to come out because it's the short-term capital gain. That leaves us 8,750, which is smaller than the amount of our long-term capital gain. Okay, so we're going to pay tax on that at 15%. Then we take that 8,750 away from the 10,000, which leaves $1,250 more dollars to pay tax on. When we pay tax on that at the rate of 20%. Okay, so for the bulk of that capital gain, we're paying 15%. For the rest of it, we're paying 20%. So the tax on the long-term capital gain is these two numbers added together, basically 1,562.50. All right. Then we still have the amounts of money that was not taxed yet, that 4,700 up at the top. Okay. 10,000 of it got taxed at the long-term capital gain rate. The other 4,700 needs to be dealt with now. That's why and we're not getting a preferential rate here. That's why we had to go back to the tax rate schedule. We calculated 757. We add the long-term calculation with the ordinary income calculation for the ordinary taxable and come up with $2,319. Then they want us to go back. I think it's just to prove to us that we're getting a break. If we would have calculated the tax on all of our money at just the tax rate schedule for the fiduciary tax form, the 1041, we would have paid the $3,700 in tax. Choose the smaller one. Obviously, it's going to be the one where we got the preferential rate, the 43. So we're going to pay $2,319.50 on that income. Okay, we're happy about that, aren't we? That ends up going to line 1 on Schedule G, which is on page 2 of the inheritance tax, or excuse me, of the 1041. And I've run out of time, basically, haven't I? So we will pick up at this point, going back to Schedule G when we get together on Tuesday. Does anybody have any questions? I'm gonna stop sharing so I can see you all. Okay, anybody have any questions? This is it seems a lot more difficult, a lot more complicated than what we've been doing prior to this, doesn't it? You just have to follow the directions, have to know the basic concept of what we're trying to prove, and then follow the directions. The biggest problem that you're going to have if you have to calculate the tax on page 2 of the Schedule D is keeping track of what number goes where. There's a very, very good opportunity to make a mistake because you didn't read the instructions correctly. That's the biggest problem that you're going to have. You know, so now what we've seen is that a long-term capital gain gets a preferential treatment. One of the only ways that we're going to pay tax on the 1041 is if we have a capital gain. So I'm telling you right now, there's a very good chance you're going to always, a great majority of the time, be calculating your actual tax on the back of the Schedule D and not using the tax rate schedule that's in the instructions, except for, you know, the part of it that's going to be taxed at an ordinary rate. If that was all capital gain rate, then we would have had a much lower tax even. All right, if there's no questions, then we'll call it a day. I think I'm probably going to just do the rest of my day remotely. So if you have me for an afternoon class, expect that we're going to do it remotely. I don't think I'm going to be able to get out of my driveway to get home, to get to class today. So my 1 o'clock and my 2:30 class will also be remote. I'll send out emails to everybody letting them know that. Sorry about that, Austin. But in the BCom class, everybody will just end up doing this. That's going to be presenting today. They'll just end up presenting on Zoom. So that'll be a little bit easier for everybody, hopefully. If there's no questions, then hopefully I'll see you guys on Tuesday. I'm gonna go make a snowman during lunch. Bye.
Have a good weekend.
Thanks, you too.